Hello, I'm John A.G., and I want you to picture a moment that feels familiar but unsettling. You're watching something you trusted behave in a way that doesn't match your memory of it. Not suddenly, not explosively, just enough that your internal compass starts to drift. You can't point to a single event where it broke, but you can feel that whatever sense of order you had is no longer reliable. That's where the silver market is right now, and more importantly, that's where many investors find themselves without fully realizing it. For a long time, silver felt like one of the easier stories to tell yourself. Demand narratives lined up. Supply narratives lined up. Price momentum rewarded conviction. And when a market rewards conviction repeatedly, confidence quietly mutates into certainty. Certainty doesn't announce itself. It just removes doubt. And when doubt disappears, risk stops being measured and starts being assumed away. That's why what just happened matters more than the percentage drop flashing on your screen. Silver didn't just fall. It failed in a way that exposes how fragile the structure underneath had become. Prices slid another 13% in a single session, settling in the mid-70s per ounce in early U.S. trading. The iShares Silver Trust, the instrument millions rely on as a clean liquid proxy for silver exposure, dropped nearly 15% in a matter of hours. This wasn't a slow reassessment, it was a rupture. And yet, the most important detail isn't the violence of the move, it's what came with it. Julius Baer's Carsten Menke issued a warning that cuts through all the noise. The market has not found equilibrium. That sentence is uncomfortable because it offers no resolution. It doesn't tell you where silver should be. It tells you where it isn't. And markets that haven't found equilibrium are not done teaching lessons. When people hear that a bottom hasn't been confirmed, they often translate it emotionally as prices could go lower. That's true, but incomplete. The deeper implication is that the forces driving price are still active. Sellers are not finished. Buyers are not confident. The balance between the two hasn't stabilized. In that environment, price becomes less informative and more reactive. This is where the false comfort trap opens. After a sharp decline, the human instinct is to anchor to what feels obvious. Silver was higher before. Silver has long-term value. Silver has structural demand. All of those statements can be true and still be useless in the short run. Markets don't move on truths, they move on pressure. And pressure builds where leverage and expectation intersect. Earlier this year, silver reached a peak above $120 per ounce. Momentum was powerful. Narratives around solar demand, electrification, and supply tightness fed into one another. As price rose, participation increased. As participation increased, leverage crept in. That leverage didn't just magnify gains. It rewired the market. It turned normal pullbacks into existential threats for anyone positioned too aggressively. Now silver is down roughly 35% from that peak. That magnitude matters because it changes behavior. A correction invites analysis. A crash forces reaction. And reaction, especially when capital is borrowed, rarely happens at rational levels. It happens wherever the market demands it. One of the earliest clues that this move was structural came from where it started. As silver approached the $90 area, selling pressure intensified. That level wasn't just psychological, it was technical, watched by traders, algorithms, and risk systems across the globe. When price failed there, selling cascaded. Profit-taking became liquidation. Liquidation became forced selling. And in a market with thinning liquidity, each wave amplified the next. This is the first mechanism that matters more than any headline explanation. Leveraged markets don't unwind because opinions change. They unwind because constraints are hit. Margin requirements rise. Risk limits are breached. Positions are closed. Not because the thesis is wrong, but because the account can no longer carry it. When that process starts, it feeds on itself. Volatility exposes this brutally. In calm conditions, a large sell order barely ripples the surface. In stressed conditions, it moves price violently. That's why silver saw intraday swings that would normally take weeks to unfold. Thin liquidity turns disagreement into shock. There were plenty of surface explanations offered. A stronger U.S. dollar, reduced geopolitical tension, profit-taking after gains, all of those played a role. None of them explained the scale. They explained the spark, not the fire. The fire came from positioning built during the ascent. Another signal appeared outside the trading community entirely. Pandora, one of the world's largest jewelry companies, announced it was shifting some designs away from silver toward platinum plating. Not because platinum suddenly became more attractive, but because silver's volatility became unmanageable. When a company that relies on silver says, "We are not a silver trader," it's telling you volatility has crossed from financial inconvenience into operational risk. That matters because markets don't just respond to price, they respond to behavior. When end users adjust, even slightly, demand at the margin changes, and markets turn at the margin, not at the extremes. Technically, the picture remains unstable. The repeated rejection near $90 has hardened that zone into meaningful resistance. On the downside, levels in the low 70s and below are being watched not because they're magical, but because breaking them invites longer-term trend followers into the conversation. That's a different class of participant, and they don't trade narratives. The unsettling part is who is missing. Many retail traders who rode the rally higher have already been forced out. Margin calls don't leave press releases, but their absence is felt. The bids that used to appear reflexively on dips now hesitate. Without that marginal buyer, price discovery becomes thinner, more erratic, more prone to overshoot. Fundamentals haven't vanished. Supply constraints still exist. Industrial uses remain. But the market isn't trading fundamentals right now. It's trading balance sheets, expectations, and forced behavior. Those forces resolve slowly and painfully. History offers a frame here, not as prediction but as pattern. Violent advances tend to end in violent corrections. Violent corrections rarely end cleanly. They end when participation has been exhausted, when confidence drains not just from price, but from people. That process feels chaotic while it's happening, and obvious only in hindsight. Silver is in that process now. Not broken, not stabilized. Searching for equilibrium it hasn't yet found, and until it does, the most dangerous assumption you can make is that the path ahead will behave the way it used to. As this phase unfolds, the danger isn't confusion. Confusion is obvious. The real danger is familiarity returning too early. After a violent move, the mind starts rebuilding order before the market has finished dismantling it. New explanations settle in. New ranges feel established. And slowly, almost subconsciously, people begin to behave as if the environment has stabilized when it hasn't. That's when losses deepen, not because price collapses, but because expectations drift out of sync with reality. What's happening in silver now is not simply a reaction to price. It's a reaction to shifting assumptions about power, control, and restraint. One of the most underestimated catalysts in this entire move was political rather than technical. The nomination of Kevin Warsh as Federal Reserve Chair changed how markets model the future, not in dramatic headlines, but in subtle recalibrations. Warsh is widely seen as less tolerant of perpetual balance sheet expansion and more inclined toward fiscal discipline. Whether that perception proves accurate is almost beside the point. Markets trade expectations first, outcomes later, and the expectation that monetary accommodation may be more limited going forward alters the perceived need for protection. Silver doesn't need policy tightening to fall. It only needs the belief that dilution may be less aggressive than previously assumed. That belief strengthens the dollar, even marginally, and marginal changes matter. A stronger dollar tightens global financial conditions. It raises the effective cost of dollar-priced commodities for international buyers. It redirects capital toward yield and away from insurance. None of these shifts need to be extreme to matter. They only need to occur while leverage is elevated. This is how second-order effects begin to dominate price. The market isn't reacting to one policy decision. It's reacting to a cascade of incentives adjusting at the same time. As expectations shift, hedges are reduced. As hedges are reduced, flows reverse. As flows reverse, volatility increases, and increased volatility feeds back into risk systems, forcing further reductions. Liquidity doesn't disappear all at once. It thins. Market makers widen spreads. Depth evaporates near key levels. Orders that would have been absorbed a month ago now move price aggressively. This is why silver's recent moves feel disproportionate to the news. The market isn't fragile because of fundamentals. It's fragile because participation has changed. ETF dynamics amplify this fragility. When investors redeem shares in silver-backed funds, metal must be sold regardless of price or conviction. Those sales are mechanical. They don't pause to assess value. They occur because the structure demands it. In periods of stress, those flows can overwhelm discretionary buyers, especially when those buyers are waiting for confirmation rather than stepping in blindly. At the same time, physical demand behaves differently than many expect. Buyers in Asia and other regions are still present, but they are selective. They buy weakness, not narratives. They scale in slowly. They wait for exhaustion. This patience can look like absence in the paper market, but it isn't. It simply operates on a different clock. The calendar now becomes a source of tension rather than clarity. Key economic data releases sit ahead, not as information points, but as narrative reset buttons. Employment data and inflation figures don't just move markets. They validate or challenge the stories investors are telling themselves about policy direction. Until those stories are tested, positioning remains unstable. This is why precision trading in this environment is so punishing. Directional correctness is no longer enough. Timing alone doesn't save you. Even a correct thesis can be destroyed by an unfavorable path. A temporary move against a position becomes permanent when leverage is involved. Markets don't care that you were right eventually. They only care whether you can stay solvent long enough to find out. Beneath the surface, something else has already changed. Retail participation has been damaged. Many traders who chased silver higher have been forced out. Their capital is gone. Their willingness to re-enter is diminished. That matters because those participants often provide the reflexive bids that stabilize pullbacks. Without them, price action becomes more erratic and less forgiving. This creates a psychological trap. The sharper the decline, the stronger the temptation to believe the opportunity is obvious. Pain gets mistaken for value, but markets don't reward obviousness. They reward alignment with structure, and right now, the structure is still in flux. History offers a useful warning here. The most painful drawdowns rarely come from being wrong about the long-term direction. They come from being right too early with too much exposure. Past commodity cycles show that final lows are rarely marked by compelling arguments. They're marked by disinterest, by silence, by a lack of urgency. Silver hasn't reached that state. Volatility remains elevated. Opinions remain loud. Social conviction remains polarized. Those are signs of an unresolved market, not a settled one. Zooming out, the broader risk environment adds another layer of complexity. Equity markets have shown strain. Yield expectations have shifted. Investors are increasingly sensitive to uncertainty around growth, costs, and policy coherence. In such conditions, correlations tighten. Assets that usually hedge one another can move together as capital prioritizes liquidity over theory. This doesn't negate silver's long-term role. It complicates its short-term behavior. And confusing those two timeframes is where damage compounds. What should unsettle you isn't that silver is down sharply. It's that confidence on both sides remains high. Bulls and bears speak with equal certainty, just in opposite directions. That symmetry is rarely a sign of clarity. It's a sign the market is still negotiating its identity. As long as equilibrium remains elusive, moves will feel arbitrary, reactions exaggerated, and patience uncomfortable. That discomfort isn't a call to action. It's a signal that the framework being used may no longer fit the environment. Because the next phase isn't about whether silver is cheap or expensive, it's about what fails next if assumptions break again. And that question won't be answered by charts alone. It will be answered by behavior, incentives, and who is still willing or forced to participate. By the time a market reaches this stage, the most important signals stop coming from price and start coming from behavior. What people do quietly matters more than what they say loudly. You can see it in hesitation, in reduced position sizes, in the way rallies are sold faster than dips are bought. These are not emotional reactions, they are adaptive ones. And they tell you the market is still defending itself from something it doesn't fully understand yet. The next risk silver faces isn't another dramatic collapse. Those events feel decisive, but they're easy to process. The deeper risk is a prolonged stretch of instability that slowly drains conviction from everyone involved. A market that moves just enough to punish action, but not enough to reward patience. That kind of environment doesn't wipe people out overnight. It wears them down. And exhaustion is often the final ingredient before equilibrium forms. If volatility remains elevated, the consequences extend beyond traders. Businesses that rely on silver as an input will continue to adapt. Hedging strategies become more conservative. Inventory decisions change. Substitutes become more attractive, not because they're better, but because they're more predictable. These shifts don't show up immediately in demand statistics. They show up later, after behavior has already changed. Policy expectations also continue to work in the background. Markets don't need new decisions to reprice. They only need reinforcement of beliefs. If upcoming economic data supports the idea of restraint rather than rescue, that belief hardens. And precious metals, which derive much of their appeal from distrust in policy durability, respond to that hardening by shedding premium, not collapsing, but compressing. This is why framing the moment as bullish or bearish misses the point. What's unfolding is a transition. The old narrative no longer fits cleanly, but the new one hasn't stabilized. In that gap, price becomes erratic, sentiment becomes polarized, and confidence becomes fragile. The asymmetry between participants becomes critical here. Someone holding physical silver without leverage experiences this phase as psychological discomfort. Someone holding leveraged exposure experiences it as an existential threat. The market doesn't care which one you are. It responds to forced behavior, not intention. That distinction explains why being correct is not the same as being right. A correct thesis that cannot survive volatility is functionally wrong. Markets don't reward foresight if the path to validation is intolerable. They reward alignment between exposure and environment. This is where mental models quietly outperform predictions. Instead of asking where silver should go, a more useful question is what kind of movement the market is currently capable of sustaining. Large, smooth trends require confidence and liquidity. Choppy, violent swings signal distrust and constraint. Right now, silver is exhibiting the latter. There's also a misconception that extreme moves must be followed by equally extreme reversals. Sometimes they are, but just as often the reversal takes the form of time rather than price. Weeks or months of erratic movement that drain interest, reduce participation, and make the asset feel irrelevant. That outcome doesn't satisfy narratives, which is why it's frequently ignored, yet it's one of the most common ways markets reset. The broader backdrop reinforces this uncertainty. Risk appetite remains fragile across asset classes. Investors are highly sensitive to data surprises, policy tone, and geopolitical shifts. In such an environment, silver doesn't dictate its own fate. It's pulled into broader flows, sometimes benefiting, sometimes suffering, but rarely acting independently. This is how confidence fails quietly, not in a single collapse, but in the slow realization that familiar strategies no longer work. When that realization spreads, participation drops further. And when participation drops, volatility doesn't disappear, it becomes more erratic. Eventually, something changes. It might be a clear shift in policy expectations. It might be a sustained move in the dollar. It might be renewed geopolitical stress that restores demand for protection. Or it might simply be exhaustion, the moment when there are no weak hands left to force out. Whatever the catalyst, it only matters if the market structure can support it. Until then, silver remains suspended between what it was and what it will become. Not broken, not healed, just unresolved. And that leads to the most uncomfortable question of all, one that sits beneath every chart and every argument. In a market that can move this violently without warning, how many of the assumptions you're relying on are still valid, and how many are simply echoes from a phase that no longer exists?